Hello, everyone, and welcome to another Wall Street for Main Street podcast. Today, we have a returning guest, Jason Stevens of Sprott Global and Sprott Money. Jason, welcome back.
Thanks, John. Thanks for having me.
All right. First thing I want to get to is just right now, you've been spending most of your time in the mining sector and the gold and silver market. Right now, what do you see with the gold and silver price action? Do you see, over the next 6 to 8 months, do you still think this basing low will continue, or?
Yeah, I think, if you would have talked to me earlier this year, I think what I would have told you and what I've been telling many of my clients is that we could see a channel or a flat trading range for gold and silver. And for gold, much like we saw in the 1998 to 2002 market, we saw a long, flat trading pattern between $250 and $300 per ounce. And I think that's exactly what we're seeing between $1,200 and $1,400. And you've started to see a lack of volatility. So I remember, less than probably a year to 2 years ago, $20, $30 a day move in gold prices was the norm. Now we're seeing up and down days of $5, maybe $10. But for the most part, the volatility has come off, and we're seeing much more price action between the $1,200 and $1,400 levels. And I think that has a lot to do with speculators getting in and out and not looking for the longer-term potential for inflation, for rising costs. That's just not in their long-term time frame. In their short-term time frame. A lot of these people have been hit by the market, or hit by a market that's been almost cut in half over the last 2 to 3 years, and for the most part, they're now looking for some sort of short-term capital gains, short-term trading profits, as opposed to the potential upside in either the metals or the mining shares.
Yeah, I'm definitely seeing that. I remember, I forget if it was Friday or Thursday. I forget which exact day it was last week. Recently, that the June lows broke. And I was actually expecting, when the June lows for silver to break, I was expecting like a once it hit that below the 18-19, it was going to be just a big sell-off, maybe down to 16, but we really didn't see that. It went to like 1780, which compared to April of 2013, that was a nothing sell-off to me, if you ask me. And I'm just doing it on a comparison basis.
Right, and I think most of that price action proves that it's strictly technical. There's no fundamental basis for gold and silver to be. I think for the most part, fundamental analysis on these metals has very little to do with it. And by fundamental, I mean actually taking into account the cost of production. I don't necessarily feel that because gold is a precious metal and you don't consume it, that all of or let's say 90% of the metal ever mined is still above ground, and it's still actually at some price supply. But I think the industry seems to perceive it, the fundamental cost of production, as some sort of bottom for gold and precious metal prices. So people should keep that in their mind when they look at these major mining companies. But it doesn't really make a whole lot of sense to call that some sort of fundamental value for an ounce of gold or an ounce of silver.
Mm-hmm. And one thing you said in an interview right now, do you see, it was talking about consolidation in the mining sector. Do you see a lot of major companies trying to buy out little small juniors right now?
So we don't see it in terms of big big companies taking over small companies, and actually there's a rare case that just happened recently, but for the most part what it is either similar size companies looking at each other, or a big mining company looking at another smaller mining company or actual producer. So it's not like a big company looking at a exploration company for the most part. It's a big company looking at a smaller producer or somewhere where they have similar costs that they can consolidate, or take those costs off the table between the two parties. I guess if we're talking about total M&A in the mining sector, yes, we're seeing a tripling between Q1 and Q2 of the M&A activity. And I guess the biggest transaction that happened was Agnico Eagle and Yamana partnered up on the acquisition of Osisko Mining, which has a project in Quebec, and that transaction was $3.6 billion, and by far the biggest one that we've seen so far. There was recently a very surprising transaction by Agnico Eagle going in and buying a very early stage company called Caden Resources for $205 million, which is a company. Caden is truly an exploration company with no resources to speak of, and that's why it's so surprising. This is a company with nothing more than some impressive drill results that was bought out for $205 million at the time they announced the deal.
Yeah, it sounds like there could have been definitely better candidates right now in terms of taking out, but then again, no one accused the resource sector of having good management. So, in fact, one of my complaints about it is the management a lot of the companies aren't well managed. And I was wondering, from your perspective, I do think, even though obviously the gold crash, no matter what, if your number one commodity takes a hit, the industry is going to suffer. But I do think they're also paying for years of bad management, of growth for growth's sake, buy any asset, overlooking cost, and then just frivolously spending money. Would you agree with that statement, or did you want to add or
Yeah, absolutely. I think you nailed it on the head when you said growth for growth's sake. And I don't know that it's all assets, but for the most part, in the mid-2000s, you had major mining companies buying whatever deposits they could over 5 million ounces, and taking very little consideration to profitability of ounces, just looking for the most ounces out there. So a couple of those assets were Fruta del Norte that Kinross bought from Uranium, and that is now a deposit that still, it's in Ecuador, so they came up with political issues. So that was a huge, I think that was $1.1 billion acquisition, and may have even looked good if they had been able to develop out the full project, put in the infrastructure. But there was also Tasiast, which was another Kinross acquisition that I believe they paid something north of $10 billion for, and that basically marked the top of the mining market. But what they found when they actually went to develop out Tasiast was the fact that they were going to have to put in all new processing facilities because it wasn't the type of deposit that they expected. So that was a big reason for the underperformance of Kinross over the last 7 years. And I think Kinross, for the most part, hasn't recovered from that and has taken, I think, since then about $4 to $7 billion worth of write-offs since 2010. So very big write-offs on very large assets, and hopefully they've gotten that behind them so they can start working forward from there. But at the same time, they're obviously gun-shy, and I think that's going to be taken well into account when they start looking at new assets. And when they become gun-shy, they don't make smart decisions either. They're either over-aggressive or under-aggressive. And I think at this point, you're not seeing Kinross do a whole lot in terms of new development opportunities.
Yeah, Kinross, I don't know too much about them, so all I know is that during 2010, even when I was looking for miners, I remember two of my friends, one of them my colleague, they used to say, don't ever get Kinross, so never really looked into it. Now I know why. But you brought up a good point about political risk, and I know, obviously, you work with Sprott, so I'm sure you've heard about Mexico's mining tax. And I was wondering, what do you, now that it's implemented and it's in, how much difference, are you seeing that much of a difference in the tax and its effects on miners right away? Or do you think it's more of a long-term sort of, like it's not showing up right away, but it will show up, years down the road?
No, I actually don't think it'll have that big of an effect on the actual mining companies. We actually had a number of different Mexican exploration development companies that were potentially going to be affected by this, even though they didn't have producing assets yet. But they did do some sort of cost analysis of after these taxes went into place, and it wasn't a huge effect. I think it's somewhat and I can't speak to the details right now, but when we looked at it, it was only a fraction of the production that was actually subject to this tax. So it didn't have as big of an effect as I think the market assumed, and I think that's why, obviously in this sort of weak market, you're not going to be able to attribute the tax law to the weakness, because everything's been weak. But at the same time, I don't think even in a good market, or let's say a stable market with gold prices above the all-in sustaining cash or all-in sustaining costs of production, would it make a big effect on cash flows over and above what taxes Mexico already had in place?
Oh, okay. And I was also wondering one other thing about mining. This just came into my mind. I was thinking about right now, silver's is at $17. And I look at a lot of these costs, and the low-cost producers I look at, their all-in cost is $18. How long do you think some of these silver miners can survive $17? Do you think there's a time frame, or do you think
it's going to depend on the assets, and it's also going to depend on whether or not these are primary mines? A lot of times you can also look at some of these Mexican projects, and they have byproducts that bring down their overall costs of production. So they might produce silver at 17, but you add in the copper or gold, and you start reducing the per ounce cost, and as a byproduct credit. And it's going to depend, and so it's kind of hard for me to say on an individual basis. It also has to do with holding costs, corporate costs, G&A, all those things that are associated with those specific projects are going to be kind of taken into consideration when they decide whether or not to keep the mine open or close them. And I know Adrian Day had talked a lot about shutting down mines and then them not being able to be reopened. That's very true. If these mines shut down, they have pushed it to the brink to where it does not make sense for them to turn them back on for a very long time in their own name. So over time they might be rehabilitated, but it's not going to be anytime soon.
Yeah, I definitely. That's one reason I think the mining sector can last a lot longer than what people think. Because if you shut down a mine, you're throwing in the towel, and a lot of these people have like Santa Cruz is one company I follow. It's not a recommendation or anything, but inside ownership's 44% or roughly 40%. They're not going to throw in the towel quickly. They're going to do whatever they can to keep that afloat.
Not only that, but it's very expensive to shut down a mine. It's very expensive. It's very expensive to shut down the mine. It's very expensive to bring it back up. So there are a lot of costs to be had just by, what most people think is shutting down and walking away from a project. So you're right. It's not going to be an easy decision, nor is it going to be one that any mining company can afford to take lightly.
Mm-hmm. And one other thing is also, speaking of the mining sector, obviously, you're very bullish on precious metals and mining. Even if someone doesn't know who Jason Stevens is, they know you work for Sprott and Rick Rule, and I'm sure you get that job because you're bullish on mining. In terms of opportunity, everyone, 08, the 08 crisis, after that crash, gold soared to 1900 a couple years later. That was a great opportunity. And 2000 was, I would say, 1998, 2003. In terms of the opportunity now, in terms of making money off investing in the right companies, which opportunity? Do you see it more like the 08 opportunity or like the 2003 opportunity, or is it a little different or a little in between?
I definitely find more parallels to the 98 to 2002 market, where after 2002 you saw a sustainable rise over 2003 to 2007, 2008, pretty much uninterrupted by a very sustainable rise in gold prices. What we're seeing now seems to be the long flat pattern in gold prices that we saw in 98 to 2002 after you saw a significant sell-off from the 1996 highs. So I can't tell you that, obviously, no one can tell you that it's going to look exactly the same, but we're starting to see that the M&A activity of companies at a smaller level, exploration development companies, sub-$100 million market caps, that they're only doing it to cut G&A costs because these transactions make sense to cut G&A costs. A lot of times these mining companies don't do transactions with the thought of the shareholders in mind, but more so their long-term employment plans. And at this point, you're seeing a lot of the companies that have large portfolios of projects and realize that they need to be developed in a more sustainable fashion, merging together with the idea that the projects and the assets come together and become more of I would say, the next discovery cycle. And we didn't see that a lot we never see that in peak gold or in higher commodity price environments. We always see it when companies need to really do the cost cutting, the G&A cutting, all the things that you see in the worst depths of the time. They can only pay the light bill and pay employees so long before they start cutting those necessary costs by merging the assets, merging the companies into transactions and companies that make sense.
Mm-hmm. And also, being with Sprott, I was wondering, you're on the front lines for this. Who's right now interested in making investments in the I wouldn't say precious metals, but the mining sector? What type of person or institution do you see actively trying to get involved in the mining sector right now?
Well, I'm glad you not only bring up people, but also institutions, because both of them are. And these are people that, if you follow the mining sector, you've heard of before. People like Pierre Lassonde and Ross Beatty and the Lundin Group, so Lucas Lundin. They are all getting involved not only in financing their own companies, but also individual private placement deals on smaller companies, which in the future they might their equity interests in their own companies might have an interest in. So you're seeing the kind of the serially successful entrepreneurs in the mining business get interested in the smaller junior developer sector, but you're also seeing $8 billion of private equity dollars that are on the sideline with money earmarked for the mining sector. Now, these aren't going to be the smaller junior sector companies, but they will be the transactions that I think keep the eyes on this market. So, you know, we always say in a turnaround, when you see gold prices that have drifted down and start to turn back up, the first leg of the bull market, you start to see the large companies, the multi-billion-dollar Newmonts, Goldcorps, Barricks move first. Franco-Nevada's, Royal Golds, all those companies move first. And I think for the most part, that's who the private equity companies are. I don't want to say they're looking to do deals with those companies, but they're looking for assets similar to what those major mining companies are looking for. So the big dollar investments that will get the attention of the big mining companies. And you're seeing that private equity money coming out of Hong Kong for a lot of it. You're seeing it out of Korea. You're seeing it out of China or other parts of China outside of Hong Kong. So the Asians are putting together private equity cash. The Koreans. I guess that's really where I see it mostly coming from right now. And we do have a couple of deals, or Sprott has a couple of private equity deals that I know are part of that. So we are certainly looking for those transactions to not only start taking place, but they have, to a small extent, taken place. But there's more to come, definitely more to come.
So it sounds like, based on what you told, that these are pretty strong hands coming in the mining sector. Would you agree with that? Or
absolutely. Private equity money is not something that, they're not speculations. They're not money that turns over really easily. You know, we tend to think of long-term assets in 5 to 10 year time frames. When you're looking at a sovereign entity like China, Korea, those sort of entities, we're talking about securing the end product for maybe a century, 50 to 100 years.
Yeah, it doesn't look like China's looking to flip this anytime soon.
Right.
And one other thing about who's entering, do you think, from what you've seen, is anyone leaving the PM market now, or do you think all the weak hands are shaken out?
And I alluded to this a little bit before, but I don't know that they're leaving, because I think for the most part we've shaken loose, or in the last, I would say in 2013 we shook loose most of the weak hands. What we're seeing now is opportunists, people that are truly, they're not long-term buyers, they're more traders, and so that's what's going to take these markets within this channel. And I don't think we see the gold prices moving out of this channel until we see good reason for the reason most people own gold, like inflationary pressures or true geopolitical instability. So we haven't seen either of those. And I think for the most part, we don't have people necessarily moving out wholeheartedly. Many of the funds did that, and many of the big momentum players that got hurt coming off the 2011 peaks are already out. And I think that's the main reason why we're not seeing gold sell off, much below 1,200, is because people who play this momentum trade through these channels, they're not looking for big moves, but if they see losses, they cut their losses quick, and then they ride the next up move from 1,200 to 1,400 pretty quickly. They jump back on the bandwagon pretty quickly.
Mm-hmm. And it's also one thing about the mining sector. Right now, I was just wondering one question. This, for some reason, popped into my head. But people have talked about a Barrick and Newmont merger. Mm-hmm. Do you have any just thoughts on that, or is it even possible? Or
I think the fact that it was so publicized for a while is a product of the fact that it was so close. And I think it was much closer than many people realized. And I don't know exactly why it fell apart, but there are definitely egos involved when it comes to these larger mining companies. And what has happened over the last 2-3 years has only exacerbated those rivalries. I think that these sorts of transactions should take place, and I think, as my boss Rick Rule has said, they inevitably will take place. But if they don't happen, the mining sector as a whole loses out or shareholders, lose out because they have a lot of overlap. They have a lot of G&A overlap, a lot of operations overlap that can be cut, and bringing down cost of production and a lot of duplications of processes. So it should happen, but will it happen? I'm not sure.
Yeah. And also, I was right now I've listened to David Morgan, and he was saying that in 2000 and a lot of other bottoms, that the junior resource sector, the small cap, was the sweet spot. But he thinks now with bad financing or I don't know if he says it, but I remember hearing this from someone. I think it was David Morgan. I don't want to put words in his mouth. So, but the mid cap will now be the new sweet spot because they'll buy out a lot of the good junior resource sectors. Do you still see the junior resource as a sweet spot, which you'll hear talked about in a lot of newsletters, or do you think this time it might be the mid caps companies?
So, are we talking about the mid-tier or mid-cap producers, or are we talking about the
I would say mid-tier producers, like I would say like a New Gold as an example.
Okay. I think when we're talking about the juniors, I'm assuming you're referring to
like Gran Colombia or like
the exploration companies.
Yeah, Gran Colombia or Lexico.
Okay.
That's what I mean.
Those are, for the most part, either development companies or small mining companies that you're referring to. And I think the juniors, for the most part, there's nothing, you can't get away from the fact that the juniors are juniors for a reason. They have small market caps. They have a tougher time. They don't necessarily have fully mature assets. And for that fact, when a company goes from uneconomic projects to economic projects, that's where you're going to see the most potential for capital gains. It's going to be the most risky. It's going to be but it's also going to have the most upside. And I don't think there's anything that's going to change that. What I think either David Morgan or yourself are kind of alluding to is the fact that what moves first, or what moves the best in a freshly rebounded market, are the ones with the mature assets, the companies that have a direct link to profitability and a higher gold price. So an exploration company, if gold prices go up, it shouldn't really affect them because they don't have any gold. They don't have anything proven to say that I can economically mine this gold, so higher gold prices will directly affect me. A mining company, a mid-tier, even a junior producer, are affected because, for the most part, low gold prices make them marginal. At higher gold prices means and this is how Eric Sprott has told the market, for the most part, why he is investing in smaller, I would say, marginal producers. And that's because as gold prices move up, their profit margins move up exponentially. And I think that's for the most part why maybe people like David Morgan might think that there's more short-term potential in those companies.
Okay, that's definitely makes a lot of sense. So, I also one thing also is I actually wanted to switch topics now to something you're also very bullish on, and that is the uranium market. Can you just give a brief overview of what makes you excited about the uranium market?
Sure. For the most part, it really has more to do with the fact that I think in the energy market, uranium is probably the most exciting opportunity I've seen in a long time. You have Cameco, who produces some of the largest, or is developing some of the largest assets in the world, saying that the cost of production rounds out between $50 and $70 per pound. Yet we have uranium prices, I think they're sitting right around $35 a pound after a short recovery off a bottom of $28 a pound. So I am of the belief that the pressure over the next 2 to 3 years that comes from 55 nuclear reactors going up in Asia, and then low uranium prices here in the U.S., there's a arbitrage there. Something has to give. Either those uranium mines don't demand the uranium that we all imply that they should be demanding, or the mines just don't produce, or the mines that have been developed or are in the process of being defined don't produce the uranium. So those mines, it doesn't make sense to mine something that's trading for $35 a pound when costs are north of 50. That only happens for so long till mines shut down. And I think, for the most part, that's what you're seeing in the mines that are operating currently. You're starting to see that legacy assets are starting to shut down, and even the highest grade assets in the Athabasca Basin, which is kind of the Saudi Arabia of uranium, they're just not being developed.
Yeah, I definitely see that. Cameco, their Cigar Lake, they're unable to get that online, and I think part of that's prices. And you see so many people building nuclear power plants, not in the developed world, but I would say more emerging markets. Like India signed a free trade deal with Australia,
right,
to import uranium. China, obviously, is building. Not only that, people forget Saudi Arabia is building 16 nuclear power plants. So it does look like nuclear, despite Japan, nuclear is here to stay.
Right, and I think even taking into consideration Japan, there are places like Japan that just don't have any other options. And I think over time, not only will the restarts start to catch the market's attention, but they're already talking, and when they started to talk about restarts, they already had proposed new nuclear plants, which they need to. The whole reason Fukushima was as bad as it was is because it was an old, dated facility. So getting new, updated power plants is part of the plan that should be not only an environmental issue for them, but for the rest of the world. It's kind of crazy that we take down nuclear power plants, don't put up, and just take that power off the grid as opposed to allowing people to do upgrades or build new ones.
Yeah, and that's what Germany did, and they suffered for it. They have high electricity costs now, and they're even reconsidering, from what I've read. Have you read the same thing about Germany? They're reconsidering, or?
Well, I think they have to reconsider a lot, because I think that is kind of the green solar and wind energy mecca that a lot of people want to point to as a success. And right now, solar and wind now account for less than 7% of their total energy. So I think they have to reassess, because their plan was to build out all these renewable projects, and they're starting to realize that these things don't scale. And I think nuclear is something that not only scales, but it scales very well, as long as you start to communicate with people that nothing's more green or nothing emits less carbon or carbon dioxide than nuclear.
Yeah. Not only that, nuclear, in terms of quality air, it's actually the only quote-unquote clean energy, and I put clean energy in quotes because I personally think every energy has its problems. I don't think there's really a clean energy, but nuclear power is clean for the air. It's one of the clean, quote-unquote green ones that's actually economic.
Well, when I think of clean, I always put it in quotes, because if it's not nuclear waste, it's carbon dioxide. If it's not carbon dioxide, it's some sort of people don't realize how much windmills or what windmills and solar panels are actually made of, and nobody wants to assess what those are made out of and look back at the mines that produce those, because a lot of times those rare earth elements that are put into those solar panels, windmills, come from some of the dirtiest mines in China. So, and talk about low standards in terms of mining. If you're looking at North America and most of the world, they're much higher than what China is doing with most of their processes.
Yeah, that's an excellent point. And China's not the model of clean air.
No, so. And actually, Robert Friedland, the chairman of Ivanhoe Mines, makes a series of great points when he talks about the mining sector as a whole, and how we need to reframe the whole conversation of what we produce and how it contributes to human life and quality of life for people now. And the fact that clean air in the gigacities like London, Hong Kong, a lot of the European megacities that we don't think about, and they have real true pollution problems, not global warming air problems, but air problems in the sense that they create asthma and a lot of other acute respiratory diseases. So those are the kind of pollution ideas that metals and a lot of mined products can actually help stop, like platinum in the platinum group metals and their the part that actually reduces the amount of carbon and pollutants coming out of the car. I can't remember.
I think it's the catalytic.
I'm sorry, you're exactly right. The catalytic converters.
Yeah. So, yeah, I know that. I had to write a paper on that for work for my company I work for during the day. So
okay.
That was drilled in my head pretty well.
So you should have corrected me sooner. I was looking for the word. I was looking for your help, John.
Yeah. Yeah, I'm not best with help sometimes. So.
Okay.
No, you definitely brought up great points about where that energy comes from, the mining. And one other thing is, it seems like in terms of, clean mining or mining is ripe for some sort of technological innovation, or it seems like it's due time. Would you agree with that?
I'm not a mining engineer, but what I understand is that the price of your of your product, be it metals or whatever, whatever you're mining, because they're so volatile in this space, it's very hard to start taking on research and development projects that may or may not ever yield any fruit. It's not like the oil and gas industry. Oil and gas industry is very efficient when it comes to recovering more barrels from shale or something to that effect. It's a very efficient R&D development process, from exploration in greenfield projects to services and those sorts of things. All of these integrated oil companies have the budgets. Mining has done a very poor job, and a lot of it has to do with the fact that you explore, you find an asset, and it takes 10 years before you actually make cash flow from that project on average. And think of, finding an asset that has really high-grade gold today, but in 10 years you have no concept of what the price of your product will be, and that's the time you will get the first cash flow out of that project. So it's not a good business when we look at it next to other extractive businesses.
Yeah, definitely.
So it's hard to plan. So back to your actual question, it's very hard to plan in that environment long-term technological advances, because you don't know when you're going to have the money to actually develop that research. And yes, there are specific companies that do that, but those companies only get funded during bull markets, and their technology is sometimes never funded long enough to make a new technological advances. And many times you just don't see a need for it until there's a bear market, because prices go down, and like those large-scale developments, they all make money at high gold prices, but gold prices come down. That's when they need the technology, and that's when they can't afford to fund them.
Mm-hmm. Yeah, definitely. I can definitely see that right now, especially with the cost of production. They could definitely use the technology, and like you said, it's
right. The Newmonts
they
of the
don't
world,
have the money to fund the project. So.
Right. The Newmonts of the world don't have an exploration budget to find new reserves. They're sure is not financed enough to go out and try to create new methods of recovery.
Mm-hmm. So. All right. I was going to say thank you very much for coming on. I don't want to take up too much of your time, and I'm actually getting a little tired. So,
Don, thank you very much for having me.
You're welcome. And if they wanted to find out more about you, how can they do so?
They can always look for me on the Sprott Global webpage. So Sprott, that's SPROTT Global.com, and then I have a profile page, again, Jason Stevens. They can feel free to sign up for my monthly newsletter about all of the news coming out of the resource industry. And then also, they can also email me or give me a call. My email address is jstevens, Stevens, at SprottGlobal.com, and call me at the 800 number, which is 800-477-7853.
All right, and I also have his personal thing below the interview, so you can go to his page and everything. So, one time I listened to Rick Rule talk, and he talked about how he has a great group of. It was a speech at a resource conference about great young group of people that that work for him. And this is interviewing you is completely supports what he says. So.
Thank you very much, John, for the kind words.